Imagine a world where the biggest, most complex machines, the jets soaring overhead, the massive construction equipment reshaping our landscapes, even the robotics automating our factories, they just quietly hum along. They're powered by components you've likely never even heard of. These are the unsung heroes, really, the unseen guts that make our modern world move. Today, we're taking a deep dive into Parker-Hannifin, or PH. They're a global giant in motion and control technologies. And our mission here is to unpack an investment memo, basically kick the tires and see if this company truly possesses the characteristics of what you'd call a wonderful company, one worth potentially holding for decades.
That's right. We're going to peel back the layers. We'll start with the fundamentals, the engine of the business, look at its competitive advantages, its moat, if you will, and the quality of its management. And importantly, we'll back this all up with the cold, hard numbers. The goal is really to give you a shortcut, a way to quickly understand what makes this company tick.
Okay, so let's unpack this for you. What exactly does Parker-Hannifin do? I mean, they're called a global giant, but what does that actually mean day to day?
Well, at its core, Parker-Hannifin is a global diversified manufacturer. They make highly engineered, often quite mission-critical components and integrated systems. They serve a huge array of industrial and aerospace markets, things like hydraulics, pneumatics, electromechanical components, filtration systems. It's a really vast and deliberately fragmented product portfolio.
Fragmented, okay.
Yeah, and what's truly fascinating and a real foundational strength is that no single product line accounts for more than 1% of their total revenue.
Wow, 1%. That really insulates them, doesn't it?
It absolutely does. From, the obsolescence of any one specific product or technology, it creates inherent stability.
That kind of diversification sounds incredibly stable. So with such a vast and, as you said, fragmented product portfolio, how do they organize themselves? Are there distinct operational segments? And who are they actually selling to?
Yeah, good question. There are two primary segments. First, you've got diversified industrial. This serves the OEM's original equipment manufacturers and, crucially, has a huge aftermarket business. We'll come back to that.
Good.
And you have aerospace systems. They provide those critical components for both commercial and military aircraft. And their customer base overall, just as diversified. We're talking over 430,000 customers globally.
430,000?
Yeah, it's massive. And no single customer represents more than 3% of sales. So that significantly mitigates any concentration risk, which is, a real plus for investors.
That customer diversification is seriously impressive. Okay, so they make these critical components, these systems, but how exactly does Parker-Hannifin translate that into such, robust profitability? What's the core mechanism here?
That's where it gets really interesting. Fundamentally, the profitability is driven by selling these essential high-margin components where, and this is key failure for the customer, is incredibly costly. Think downtime on a factory floor or an aircraft. But the truly attractive feature of their model, and frankly a huge part of their success story, is the aftermarket business.
Right, you mentioned that.
This accounts for over half of their sales and actually an even greater share of profits.
More than half the profit from aftermarket.
Yeah. And this revenue stream, providing replacement parts, maintenance, repairs, it's inherently recurring, it's less cyclical than selling new equipment, and it commands much higher margins. It's like the gift that keeps on giving for them.
That sounds like a powerful engine for a business, that recurring revenue. But what about longevity? I mean, can something so specialized really last for decades, even, a century plus?
Its endurance is pretty exceptional, actually. This is a company with over 100 years of history. They've been consistently making the essential, often unglamorous parts that allow complex machinery to move. I mean, we're talking about them providing the leak-free fuel system for Charles Lindbergh's Spirit of St. Louis back in the 1920s.
Wow.
All the way to the hydraulics that famously animated the mechanical shark in the 1975 film Jaws.
No kidding, the Jaws shark.
Yep. It shows the fundamental constant need for motion and control in an industrial society. And they've consistently been at the forefront.
That longevity, from Lindbergh's plane to the Jaws shark, that really does underscore this fundamental enduring need that they address. It makes you wonder, though, how does a company with such deep roots keep adapting? How do they position themselves for future growth?
Right. It speaks to their century-long capacity for adaptation. They are very strategically positioning themselves now in major secular growth trends. Think clean technologies, electrification, hydrogen.
So they're not stuck in the past.
It's not at all. A tangible example is their recent acquisition of Curtis Instruments. They're a specialist in electric vehicle controls. It's a clear move towards that future. And if you connect this to the bigger picture, the business benefits hugely from what you might call complexity and entropy. Their products are truly mission critical, meaning a tiny valve's failure can halt a multi-million-dollar system that gives them powerful pricing power. And as the industrial world just gets more complex, Parker's addressable market expands.
And entropy.
Entropy, yeah, just the natural wearing out of parts that perpetually feeds that high-margin aftermarket business we talked about. Things break, they need replacing, Parker's there.
Okay, that makes sense. So every great business needs a fortress, right? An economic moat. What specifically protects Parker-Hannifin? What stops competitors from just coming in and stealing this lucrative business?
The primary moat here, the biggest one, is high switching costs. And it's important to understand these aren't just financial costs. They're deeply operational and strategic. Parker's components are often custom designed, deeply embedded, and specified in to a customer's final product. So switching suppliers would be incredibly costly, really time-consuming, and frankly risky for the customer.
So it's not just about price.
Not at all. And this primary defense is powerfully reinforced by two secondary moats. First, you have intangible assets. They simply have the broadest technology platform in their industry. We're talking patents, trade secrets, proprietary engineering know-how. This allows them to offer integrated system solutions.
Okay.
Competitors often focus on just one or two technologies, maybe just hydraulics or just pneumatics. They can't replicate Parker's breadth easily.
And the second reinforcement.
Scale advantage. Their global distribution network is unparalleled. It was built over 50 years. It includes over 13,000 authorized distributors, more than 3,000 retail Parker stores.
3,000 stores.
Yeah, physical locations. The sheer capital and time required for a competitor to build that kind of physical logistics and service footprint, it's prohibitive. It really is.
That makes intuitive sense. It's hard to just swap out a deeply integrated system, and then you add that distribution network. Can you give us a real-world example? How does this moat actually play out?
Absolutely. Let's take a big construction equipment OEM, say an excavator manufacturer.
Yeah.
During the design phase, Parker engineers work with the OEM engineers. They collaborate on a custom hydraulic valve system, let's say. That system gets specified in to the excavator's design, the bill of materials. So for the entire production life of that excavator model, the OEM is essentially locked into buying that system from Parker. Switching would mean halting production, costly re-engineering. It's just not practical.
Right, the lock-in.
Exactly. And here's the real kicker, the aftermarket payoff. Sooner or later, a valve on that excavator out on a construction site fails. Downtime costs thousands per hour.
Yeah, time is money there.
Big time. So the operator immediately calls for the OEM specified replacement part. They need that part, the right one, now. And Parker's ubiquitous distribution network ensures rapid delivery, often same day from a local Parker store or distributor. Because of that urgency and the guarantee of the correct part, the operator willingly pays a premium. And that secures a high-margin, recurring aftermarket sale for Parker. That's the moat in action. Powerful stuff.
That's a fantastic illustration. It really brings it to life. So this moat clearly exists. It's strong. But is it just holding steady? Or is it actually getting stronger in today's world? Things change fast.
That's a key question, and the evidence strongly suggests it's actively widening. This isn't just happening by accident, it's a direct result of a very deliberate, systematic corporate strategy. The primary driver here is something called the WIN strategy. It was launched way back in 2001.
The WIN strategy.
Yeah. It's this comprehensive business system, and it institutionalizes goals like focusing on system solutions, not just components, and driving market-driven innovation. It systematically pushes Parker up the value chain. They move from being just a component supplier to an indispensable integrated systems partner.
Which deepens those relationships.
Exactly. It deepens customer relationships and fundamentally raises those switching costs even further. And this core strategy is complemented by other things, like disciplined, moat-enhancing acquisitions. We mentioned Clarcor, which makes consumable filters great aftermarket business there, and Curtis Instruments for electrification controls.
Right.
These broaden their technology base, expand the aftermarket reach, and position them perfectly for these big secular trends.
Makes sense.
And finally, there's their digital transformation. An initiative called One Parker is unifying e-commerce across all its 101 decentralized divisions. Makes it much easier for customers to access the full range of technologies, reinforcing those customer relationships again. Plus, management explicitly aims for a #1 or #2 market position in every business they're in. That further reinforces their scale advantages. So yes, definitely widening.
Okay, we've talked a lot about the business itself, its defenses, but this is an investment deep dive. So what stands out to you about how customers and employees actually perceive Parker-Hannifin? What's the scuttlebutt, as they say? Can we get a feel for that?
Yeah, we can do a sort of scuttlebutt simulation here. We can infer customer sentiment from how they're talked about, and we can look directly at employee feedback from places like Glassdoor or Comparably. For customers, it seems less about, love and maybe more about deep-seated reliance, respect, and trust. They really value Parker's technical authority, its reliability, and crucially, its availability.
Reliability and availability.
Yeah.
Key for those mission-critical parts.
Absolutely. You see things like a Reddit engineer praising the Parker documentation about their products as being invaluable, or a boater facing a complex hydraulic problem being advised online to call a place like Parker. They have pretty much anything hydraulics related. It paints this picture of an embedded partner, someone essential to the customer's success. Not flashy, maybe, but dependable.
That paints a vivid picture, yeah. An embedded partner, critical to operations. But what about the internal view? How do the people working at Parker-Hannifin feel, especially given this intense win strategy you described?
Right. The internal perspective is, well, it's positive overall, but definitely with some crucial caveats. Looking at Comparably data, you see 72% positive employee reviews, a solid B grade for culture overall. Employees praise things like collaborative teams, diversity efforts, and interestingly, 75% of new hires found their managers helpful during onboarding.
That's quite good. Okay, so generally positive, but caveats.
Yes. There are recurring criticisms, themes that pop up again and again. A perceived disconnect between the divisions out in the field and the headquarters. Comments like, corporate is out of touch, or concerns about unrealistic expectations leading to stress and burnout.
The pressure cooker effect.
Potentially, yeah. And you also have to mention the ongoing 401k lawsuit, which alleges mismanagement of retirement funds. That's certainly a shadow.
So this creates a fascinating tension, doesn't it? You've got this demanding win strategy that clearly drives operational excellence, drives those great financial results we'll get to.
Yeah.
But it seems to be creating some internal stress. What do you make of that dynamic? How might that impact things long term?
It's definitely a key tension to watch. You have this decentralized structure, these 101 divisions, but then you have this top-down, metrics-driven corporate strategy pushing hard that could create ongoing conflict. And the risk there is it could damage the engaged people pillar of the win strategy itself. You need engaged employees for long-term execution, for innovation.
Right, you can't just burn people out indefinitely.
Exactly. As one employee put it quite pointedly, corporate has different goals than the rank-and-file workers trying to holistically improve the business. It suggests a constant, delicate balancing act is needed between demanding performance and fostering a sustainable, positive internal culture. It's something to keep an eye on.
Definitely. Okay, shifting gears slightly. A wonderful company needs wonderful management, wonderful stewardship. How does Parker-Hannifin's leadership stack up?
Yeah.
Particularly when it comes to how they allocate the company's capital.
Parker's leadership culture seems very focused on stewardship and long-term health. You see continuity there. The current CEO, Jennifer Parmentier, came from within. She was the COO before taking the top job in 2023.
Okay, promoted from within.
Right. And her appointment signals really a focus on running the core business effectively and continuing the win strategy. It's seen almost as an institutional asset now, not just tied to one leader. This provides predictability and stability, which, as an investor, you really like to see.
Makes sense. And their capital allocation. How disciplined are they with the company's money?
I'd say remarkably disciplined and very shareholder-friendly. They consistently reinvest in the business through CapEx and R&D, but it's focused on that market-driven innovation that strengthens their core products and technologies. Their M&A strategy, their acquisitions also seem very disciplined. We mentioned Clarcor and Curtis Instruments. These are logical fits. They fit the existing systems, they strengthen the technology base, and importantly, they boost that high-margin aftermarket business.
So strategic acquisitions, not just empire building.
Exactly. And they have a proven ability to integrate these businesses successfully and realize the planned synergies. That's not always easy, but they seem good at it.
And what about returns directly to shareholders? Dividends, buybacks? Are they as disciplined there?
Absolutely. Parker-Hannifin is what they call a dividend king. They've increased their dividend for an incredible 68, maybe even 70, depending on the count, consecutive years.
Wow, nearly 70 years of increases.
It's amazing. They just announced another 10% increase recently, and the dividend itself is very safe. The payout ratio is only around 28% of earnings. Healthy.
Plenty of room there.
Plenty of room. They're also active share repurchasers. They deployed $750 million in buybacks in one recent 9-month period, $860 million in another fiscal year. This team consistently focuses on per-share value, not just growing the overall size of the company. They've even divested non-core businesses when it makes sense. And look, after the large mega acquisition a couple years ago, they made debt reduction a major priority. They paid down $2 billion in debt in fiscal year 2024 alone, aiming to get back to their target leverage ratio of 2.0x net debt to adjusted EBITDA.
That shows real prudence, especially after a big deal like Meggitt.
It really does. It speaks to rational, long-term focus management.
So on paper, the management sounds top-notch, disciplined, experienced. But what do the cold, hard financial numbers truly tell us about the quality of this business? Are the results just good, or are they genuinely exceptional?
Well, the numbers paint a picture of a remarkably reliable earnings machine. They've grown earnings per share, EPS, in 8 of the last 9 years, and the average annual growth rate over that period, about 15%. That's pretty impressive consistency.
15% annual EPS growth.
Yeah. And they have exceeded analyst earnings estimates for an astonishing 36 consecutive quarters.
36 quarters. That's 9 years straight.
9 years. It shows incredible consistency and perhaps management's ability to manage expectations, too. But the underlying performance is clearly strong. And this business is resilient. It was notably resilient during the 2008-2009 global financial crisis. It remained profitable, generated strong free cash flow. That's a true stress test of business quality, right?
Definitely a good time.
If we dig into the key quality ratios, their return on invested capital, ROIC, is consistently excellent. Morningstar calculates it recently at 16.7%. Valuentum, if you exclude goodwill from the calculation, finds a historical 3-year average of 26.4%. They read it excellent. These are top-tier returns on capital.
Okay, high returns. What else?
But here's the real kicker for me. Maybe the most impressive financial metric. Their free cash flow conversion.
How well earnings turn into actual cash.
Exactly. Parker-Hannifin has converted over 100% of its net income into free cash flow every single year since fiscal 2002.
Every year. For over 20 years.
Every single year. That is a stunning, exceptionally rare track record. It tells you their accounting earnings are high quality. They consistently convert to real cash available for dividends, buybacks, debt paydown, or reinvestment.
That kind of consistency is incredible.
It really is. It's a hallmark of a truly superior business model and execution. And they're not resting on their laurels. They're targeting a 17% free cash flow margin by fiscal 2029. And finally, just to round it out, their balance sheet is strong, prudently managed, hitting that comfortable 2.0x net debt to adjusted EBITDA target we mentioned. So the numbers truly quantify the success of the win strategy. You see it in expanding margins, high returns on capital, that elite cash conversion, and disciplined leverage. It's a very strong financial profile.
Okay, so the conclusion seems pretty clear. Financially strong, well-managed, strong moat looks like a wonderful company. But the crucial question for any potential investor always is it a wonderful investment at its current price? What's the valuation look like?
Right, that's the million-dollar question, isn't it? As of mid-2025, when this analysis was done, the valuation reflects a very high degree of market optimism. The trailing 12-month price-to-earnings ratio, the PE, was around 27.0x, and the price-to-free cash flow, PFCF, was about 32.0x.
47 and 32 times. How does that stack up historically or against peers?
Well, if we connect this to the bigger picture, these multiples are definitely elevated compared to its own history. Its 5-year average PE was closer to 22x, and its 10-year average was down around 18x.
It's quite a bit higher now.
Quite a bit higher. And it's also notably higher than the median PE for its industrial peers, which was sitting around 21.2x at the time.
Given those elevated multiples then, compared to his own history and his peers, what's the final judgment on the current valuation? Is it just, too expensive for a new investment right now?
I think that's a fair way to put it, yes. The market appears to fully recognize Barker's quality, its transformation, and has priced it accordingly. Perhaps even excessively so. Morningstar, for instance, assigns it a 1-star rating. They judge it to be significantly overvalued, trading at something like a 41% premium to their estimate of its fair value.
1 star out of 5. Ouch.
Yeah. So while it's clearly a wonderful company, this valuation suggests that a great deal of future success, future growth, is already baked into the current price. That leaves a pretty thin margin of safety for a new investor.
So patience might be required here.
Patience may indeed be warranted, yes. Wait for a better entry point, perhaps.
Okay. Despite the demanding valuation, let's look forward. What are the big growth drivers for Parker-Hannifin? What's going to keep this engine humming, potentially justifying that high price over the long run?
There are some powerful multi-decade secular tailwinds that Parker's really well positioned for. First, and maybe biggest, is electrification and clean technologies. Parker is acting as a critical enabler of the global energy transition. They provide engineered materials, thermal management solutions, motion and control systems for things like battery-powered vehicles, hybrid construction equipment, more electric aircraft.
So they're part of the solution, not the problem.
Exactly. And that Curtis Instruments acquisition we talked about is key here. It positions them squarely for this electric future across multiple industries. Second, there's the aerospace supercycle. We're seeing a robust recovery in commercial air travel post-pandemic, strong demand for new, more fuel-efficient aircraft, and also increased global defense spending.
And Parker's involved there.
Deeply involved. Their aerospace segment is entrenched on critical platforms like the Airbus A350, the Boeing 787, lots of military programs, and they have a strong, high-margin aftermarket business serving those fleets for decades. These are long-cycle trends, electrification and aerospace that provide years, maybe decades, of growth visibility.
Okay, those sound like solid tailwinds. But even for a company this strong, this resilient, what are the permanent risks, the things that could truly impair its value over the very long term, the potential landmines?
Yeah, even great companies have risks. I see a few potential permanent impairment risks here. One is radical technological disruption. While Parker has adapted incredibly well for over a century, you can't rule out a future breakthrough technology that completely displaces one of its core technologies, like hydraulics, in a key market.
Like something completely out of left field.
Exactly. Now, their broad technology platform mitigates this risk somewhat. They aren't relying on just one thing, but it's not entirely eliminated. Another risk, maybe more insidious, is the erosion of the win strategy culture. We touched on the internal pressures. If that intense metrics-driven culture eventually leads to widespread burnout, disengagement, maybe loss of key talent, you could see a slow decline in quality, innovation, and execution.
A slow bleed rather than a sudden shock.
Precisely. That would be a very serious long-term risk. And finally, there's always the risk of a major capital allocation misstep. Management has been exemplary so far, but the future is long. A future large acquisition that turns out to be significantly overpriced or is poorly integrated could destroy substantial shareholder value. It happens even to good companies.
Those are definitely things to keep in mind. So it sounds like the market is pretty aware of Parker-Hannifin's strengths, its transformation, maybe even pricing it for perfection. Let's engage in some second-level thinking here. What's the market potentially missing? Is there a contrarian angle?
Well, you're right. The market consensus is overwhelmingly positive. Parker is widely seen now as a high-quality, transformed industrial leader. The stock price reflects that transformation. Most analysts rate it a buy, but generally see limited near-term upside because the valuation is already high.
Okay, so the consensus is great company, expensive stock.
Pretty much. However, our deep dive analysis suggests a potential contrarian view. And it hinges on the market perhaps underestimating the durability and the compounding nature of the win strategy.
Go on.
See, the market clearly appreciates the results of the win strategy, the record margins, the strong EPS growth, the consistent cash flow we talked about, and it has re-rated the stock based on those results. But where our view, or this contrarian view, diverges is that the market might be viewing this as a successful turnaround project that's now largely complete.
Ah, like they've fixed the company, job done.
Kind of, whereas our analysis suggests the win strategy isn't just a project. It's become a permanent, self-perpetuating operating system. It's a culture of Kaizen, continuous improvement, that's been institutionalized for over 2 decades now, across multiple CEO successions. The system itself is the true star, the enduring advantage, not just the current results or the current CEO.
So the market sees the fruit, but maybe undervalues the tree.
That's a great way to put it. The market might be pricing the last turn of this improvement flywheel, while our analysis suggests this flywheel operational improvements leading to better financials, generating cash for moat widening acquisitions and R&D, which strengthens the business, leading to further operational gains will continue to spin and compound value for many years to come. value that might not yet be fully reflected, even in today's demanding stock price. That's the contrarian thesis.
That's a really interesting point, viewing the wind strategy not as a finished project, but as a perpetual motion machine, almost.
Oh.
Okay, to really challenge our thinking, let's play devil's advocate one last time. Let's do the red team challenge. How could an investment in Parker-Hannifin today, at this valuation, become a major long-term mistake, even if we accept the wonderful company premise?
Right, the red team view. We have to articulate how this could go badly wrong. The argument would go something like this. We are buying Parker-Hannifin at the absolute peak of market optimism. We are mistaking what was fundamentally a finite, albeit very successful, operational turnaround for some kind of perpetual motion machine. Okay.
The wind strategy has already harvested all the low-hanging operational fruit. Future margin gains, if any, will be incremental, much harder to achieve, and the market has already fully capitalized this peak performance into the current stock price.
So buying at the top of the cycle, essentially.
Buying at the top of the optimism cycle and the margin cycle? Yes, but there's more. Simultaneously, we are drastically underestimating the fragility of Parker's moat in the face of true technological disruption. The moat's historical strength is deeply tied to legacy systems, combustion engines, traditional hydraulic systems.
Right, the installed base.
What if electrification isn't just another trend Parker can adapt to, but is actually a Trojan horse? What if new electric native OEMs think EV startups, new aerospace players, design out Parker's traditional components entirely? They might favor fully integrated electric drivetrain systems, perhaps sourced from new competitors specializing only in electric motion.
So the very trend they're leaning into becomes a threat. Exactly. In this scenario, our perceived primary growth engine electrification actually becomes our greatest long-term threat. It could strand Parker's legacy assets, rendering their massive installed base obsolete far faster than anyone currently anticipates. And if that future unfolds, we would be buying a company with peaking margins and a structurally threatened core business, all at a peak valuation. The result wouldn't be just a temporary drawdown in the stock, but a permanent derating, a value trap. That's the red team case.
Wow, that's a sobering counterargument. Really highlights the potential risks, especially around disruption. So after all this deep dive into Parker-Hannifin, what have we learned? What are the key takeaways for you, for the listener?
Well, I think we've clearly established it's a truly wonderful company. It has a demonstrably widening economic moat, exceptional financial strength, consistently rational and disciplined management. And it's very well positioned strategically for powerful secular growth trends like electrification and aerospace that should provide tailwinds for decades.
A lot to like there, but also some important considerations we uncovered.
Right? Absolutely. The most immediate one is the demanding current valuation. It seems priced for a lot of continued success already. And there are those key risks we just discussed, particularly the long-term, albeit perhaps low probability, threat of radical technological disruption, and those internal pressures potentially stemming from its highly successful but very demanding win strategy culture.
Okay, so wonderful company, maybe not a wonderful stock price right now, with some long-term things to watch.
That seems fair. Which leaves us, and leaves you, the listener, with a final provocative thought to mull on, perhaps. How do you weigh the enduring, compounding power of a deeply ingrained operating system like the Win strategy, something systemic, cultural against today's very obvious market enthusiasm and demanding valuation? Is the system itself, the culture of continuous improvement, the most undervalued asset here, even if the stock price looks expensive on the surface? That's something to really chew on.